Hello, everyone, and thanks for joining me. Today, we're going to have a quick MEG Q2 video just to cover the name. And before I start, let's read this quick statement here. The information shared is aggregated from the public domain. So I basically take lots of information from everywhere, put it together, and trying to come up with a story that makes sense, I guess, about a certain name. But it's intended only for educational purposes only, and not intended as and shall not be understood or interpreted as investment advice. And you must do your own due diligence and talk to a professional advisor regarding any investment strategies. So thank you for that. And right now I want to start talking about MEG. Q2 will cover in detail the name and how it's been performing so far, and see what their earnings look like and what they've been up to. So I'm looking forward to it. So this is essentially a 6 months chart here on relative performance, and you can see MEG and Athabasca, they really kind of standing out here as really good performance, where even the CNQ is kind of down 2% in the last 6 months. But you know what's been exciting kind of in the last, let's say, 3 months, is that as you look at this data, like MEG had really nice move kind of towards the earnings, and actually like did extremely well and into the earnings. So we're going to cover those and see exactly what they reported, while other names did not maybe performed as well. So that's interesting. And in 1 year performance, you can really see how MEG is up 36% in 1 year. That basically starting like August 1st, I guess, from 2022. Athabasca, which essentially is like in the oil sands in situ producer, just like MEG, mainly, right? So about, I think, over 90% of their production is oil sands in situ. Really performed well at 41%. CNQ is up to only 13%. And remember, like within our community, people argued how CNQ is going to outperform a MEG or a Athabasca, but it didn't. And Crescent Point, like it's a really interesting name now that into their earnings in July did extremely well on relative basis, really trying to catch up here. And it's actually up 4.7% in 1 year, but names like Tamarack or Suncor really underperform. So that's essentially MEG performance relatively to other names. And if we kind of take a broader view, or a longer term view, I mean, look at Athabasca here, 3 years, up 18 times essentially, where MEG is up 5 times. But then if you look on the 10-year, which is extremely important to consider those time frames, Athabasca is down 57%, right, all the way down there. And like a name like CNQ is up 147%, and the MEG down minus 26. So I think timeframes are really important to consider, and that longer timeframes are more indicative of kind of what took place during the oil glut and all that in 2014, 2015. There was significant amount of pain, and you can see significant declines in equities over the course of time. But names like CNQ have been really performing extremely well, and so kind of steady Eddie in a way, just because of their size. And so it seems like to me like a lot of institutions, they kind of tend to go towards like a CNQ, and Suncor always being compared to like a name like CNQ, but MEG, it's kind of doing its own thing in the last 3 years, obviously performing extremely well like all other names. And in 1 year, which is what we've had so far, really outperforming on relative basis. So that's good. MEG, if we look right now, I will share their specs, I guess. So let's take a look at MEG here. So if we look at MEG on as a stock, I guess, by itself, so you can kind of see the 3-year chart. We had kind of a topping here, I guess, in mid 2022, like it achieved I guess its highs here, and then really declined last year, and now we're kind of back and trying to test that ceiling, I guess, on the technical chart. But if we look at the company, the market cap right now is $6.9 billion, right? I think they have something like 1.3 or $1.2 billion in debt, Canadian, and I think it's just under a billion in US. So we're talking about a company that now it's at least $8 billion in enterprise value, and which is which is up there, right? And so if you produce 100,000 barrels per day, that means that you trade roughly at 80,000 per flowing on the barrel, which is not necessarily cheap. So, but good for MEG for getting to that point. And you can see earnings per share 1.78. Next earnings in November, so that will be for Q3. And we just had earnings reported, and that's what for Q2, and that's what the video is going to be about. You can see price to earnings ratio of 13.5. So the numbers are kind of getting interesting here as we move forward. So right now, what I want to do, I want to share a little bit more about the asset and discuss kind of some more specific and kind of provide some knowledge about Q2 and what was done in Q2. So right now, I will share the AER 2022, I think. Yeah, I'm going to go up and show you exactly kind of where to look at. But this is the in situ reports for AER by the producers. And I want to talk a little bit about MEG and essentially their only asset, which makes the story extremely simple to explain. And their only asset is Christina Lake in situ SAGD operations, right? So that's why I think many people do like this name, because it's kind of simple to understand and there's not too many moving parts. So this graph shows cubes per day. So for example, and I know most people are used to barrels per day. So if you want to convert from cubes to barrels, it's 1 cube is about 6.29 barrels equivalent. So on this chart, you can see where MEG is kind of in the 2022 timeframe, achieved close to 16,000 cubes per day, which is close to 100,000 barrels per day, and now it's basically stays there. I think this chart is very powerful to explain because it really shows you the dynamic of the production and why in situ oil sands it has minimal decline over time, and it will provide a little bit more insights to how this essentially works. So you can see basically from around 2007 they're ramping up phase one, and phase one, yeah, and then they kind of go into this phase two, and they had this big turnaround, I think like last year, where oil production declined. You can see it in this chart. They had it before, and you can see the scheduled CPF turnaround. CPF stands for Central Process Facility, and it's essentially they're taking the plant down for maintenance, and they do it for about a month, and then they restore production. So what happens at that point is that the oil, essentially, they slow down the pumps, or basically don't produce from the pumps, and maybe in some cases don't inject steam. And what ends up happening is that the oil just drains to the producer, and once they produce it back, you can have flush production. And I think that's kind of what you've seen in that 2018 timeframe, where you had a turnaround, essentially oil production declined, but then it kind of flushed, so there was this peak production. And so I think, and don't take my word for it, I think that's what's probably going to happen in Q3, because you did have a turnaround scenario, and I think production was like about 85,000. So Q3, I would expect production more than 105,000 barrels per day, perhaps, because you will be producing that flush production. But you can see kind of over time what's been happening with MEG, right? You can see basically the steam to oil ratio, which is a very important indicator. You can see the oil rates, the water to steam ratio. We're going to talk a little bit more about that. You can see the well count, gas injection rates, steam, bitumen, and water rate production. So right now, let's kind of talk about the red line. So the red line is essentially steam injection rate, and you can see the relative SOR is about 2.2, and you need basically 2 barrels of steam to produce 1 barrel of oil. That's what they're showing here. And you saw like this phase 2 ramp up basically in 2014, where they had this additional phase that they developed, resulting in significant uplift in oil rates. And those oil rates went to like 13,000 cubes per day from 2014 and forward. And now they're basically ramping up even more steam injection and producing more water, but also more oil. And you can see the well count is just north of 250 wells here. So, which basically means if you produce 100,000 barrels per day and you have 250 wells, on average is about 400 barrels per day. But you could have wells that produce, let's say, over 1,000 barrels per day, and you can have wells that are producing maybe 200 barrels a day on average. So this is something to be mindful of as the asset kind of the pads decline in their production rates, and you get basically kind of this average performance. So what you see here also, the water to steam ratio, WSR, is about 1, which is healthy. So you basically kind of tracking that steam injection and water production rates over time. But since 2019, you can see increase in water production. This could be that because maybe they landed on some pads that have bottom water, or maybe there were some pads with higher water saturation in the reservoirs, but nothing too alarming here because the SOR is still maintained. And in yellow you can see they inject gas injection, which is NCG. So they inject essentially right now about 2,000 E3M3 per day. So that's about 2 million cubes a day of methane being injected, basically to reduce SOR further and maintain bottom hole pressure in the reservoirs. So in overall, the green line, that's how you make the money. And the green line here suggests that there's essentially a very limited decline in the asset and is doing quite well. So if we think about kind of their development plans, you see basically they're drilled and approved drainage pattern areas. So that's where all their pads are. So on the northeast side, you will have those pattern L and pattern DC, DE. So those are the pads, and those are different well pairs they have. And on the south side, you can have the M and the N, P, all those areas, and maybe potential expansion here in those areas, like you can see in pink. So in pink, you get approved patterns, approved development area, which is around those pads, and the central plant, which is in the middle. So you kind of can see how they're going to expand the pads and continue to develop them into the future. And it really correlates with the net pay isopox. So you can see there is this SAGD pay cutoff. So continuous bitumen over 10 meters. So basically the pay of the reservoirs, and oil saturation over 50%. So it makes sense that in the future when you have better pace and better reservoir qualities, you'll be landing in zones like here, or maybe in that region right here, right? Or maybe like here somewhere on the north side, where it's a little bit more safe, like when it comes to oil production, and where porosity is a little bit higher. And that's why you basically have a kind of low decline, high quality asset, because there is very limited risk in geology. So here you can see associated gas in communication with the pays. So you can have, let's say, a gas pool in direct or indirect contact with SAGD intervals. So there could be like a gas cup or something like this. And you can see they've been really trying to avoid the gas, because you really want to have maybe like a pay that doesn't have any like gas or water in overburden or underburden. But you can see like the expansions forward going to be associated with maybe like some more gassy zones at the upper sections maybe, or bottom water at the bottom. And this is the net basal water isopoc in communication with the pay. So you can really see how they've been trying to avoid the kind of high water places where it's almost like envision a tuxedo cake in Costco, where you have the McMurray, and then you could have like a bottom high water saturation at the bottom. So you really want to kind of limit putting wells and pads in those complex geology zones. So I think they did a good job kind of developing areas that don't have communication with those complex geologies. So here, what you can see in this slide is representative cross section within the active development area. So here you can see the SAGD pay, so just like a layer, right? And then you can see basically Wabasca, Coprock, and Clearwater at the top, and the McMurray Formation, where this is kind of will be the water sand, where maybe a little bit more water saturation. So they're going to have to mitigate and operate this at the pressure, not allowing the water to kind of come into the wells. And this is kind of development area. So you can see it seems like extremely safe. They're basically like cookie cutting those pads and kind of allocating them in the pace where they know where the oil is. And they've been doing this for many, many years very successfully. So this is injection wells by types in December 2021. And this is still ongoing because this is long life assets. So you can see steam injection on the injectors in red, where you inject steam only. So those will be normally where you develop the vertical chamber initially. And in purple, you have NCG and steam injection, where you co-inject non-condensable gases with steam to mitigate steam-to-air ratio. And those normally will be late life pads or pads with higher recovery factors, where you want to mitigate, basically, you want to maintain good bottom hole pressure, but you want to have good conformance of your steam chamber. So that's kind of what they're up to. So here you can see their, they call it Christina Lake Regional Project. This is their planned surface infrastructure within the development area. So you can see basically all their facilities here on this map associated with their operations in Christina Lake. And you can see the pads, you can see the associated infrastructure, and basically everything being disclosed to the regulator when it comes to kind of the lease boundary, the planned infrastructure, what they're going to be expanding here, and the existing footprints. And a lot of the development is underground, but you do have surface facilities that basically creating the steam to be injected to dilute or to reduce the viscosity of the oil to be produced. And on the back end, you have the facilities that kind of handle the emulsion and the gas that's being produced, and basically reusing the water to be injected in the form of steam. So this is a little bit more about their infrastructure at Christina Lake here. All right, so right now what I want to do, I wanted to pick a little bit more slides here to show you where they're at when it comes to kind of their resource and original bitumen in place. And that's kind of what people are really proud of and talk a lot about when it comes to kind of their reserves. So the project area in Christina Lake from the map that we just showed is about 4.2 billion barrels original bitumen in place. And from the development area is about half of that, right? So about 2.2 billion barrels. And they could extract the project area in the future. But on cumulative production so far that we've seen, they produce only 287 million barrels, which is about 13% of their cumulative recovery. And that's only 7% of the project area. And so when people talk about long life reserves that they can produce for the next 50, 60 years, I think that's what they're kind of talking about here. So when it comes to the reservoir parameters within the development area, basically the pay of for the development, the average pay height of basically the McMurray where they produce the oil is about 24 meters. And the average porosity range is about 30 to 36, which is very healthy and very normal to those type of reservoirs. So porous media is essentially like where the liquid could be stored. Kind of within the reservoirs. And here you have water saturation range. So in addition to oil that's saturated, as a hockey puck in that sand, you also have some water saturation. So that could be between 0.15 to 0.4 as a fraction of that. And oil will be basically the 80 to 60% oil saturation within that sand. And the average horizontal permeability, which is the ability of the fluid to move through the porous media, is about 5 Darcy, which is very high. Average vertical permeability is about 2.5, so it's a little bit less, but it's still a very high number. Like if you think about this, this is very different from shale production, right? So you usually you see like in millidarcies on shale, like very low permeability, where here everything is in Darcy, which is very cool. initial reservoir pressure about 2.1 MPa, which is 2100 kPa, and reservoir temperature is about 13 degrees Celsius. This is essentially in the vapor pressure curve. This is in kind of non-mobile phase. So you really need to inject that steam to reduce the viscosity of the oil and increase the temperature so it can be drained towards the production well. So that's why they use the SAGD process here. So this table is really important, a little bit hard to see, but I'll try doing a decent job to kind of explaining what's being seen here. So here they basically provide a table of all the patterns or all the pads they have basically in Christina Lake. You can see all of them. So they talk about the thickness, porosity, saturation, original bitumen in place in that table. So you can see, let's take pattern A. This area is 698 812 meters squared in area, and the net pay thickness of the reservoir is 22.7 meters. You can see the average porosity of 32, average oil saturation of 75, and look again, like you can see pad U or pattern U has oil saturation of 80%. Permeability 3 to 6 Darcy, so they said it's about 5, but sometimes it could get 6, which is very high permeability, which results in higher oil rates. And you can see original bitumen in place. For example, for pad N or pattern N, it's over 6 million cubes of original bitumen in place. If you want to convert it to barrels, that's over 36 million barrels original bitumen in place. And recovery to date is 46%, let's say, on N, and about 57% on A. And a pad, let's say like an AH, which is younger pad, could have a 5% recovery factor. So it kind of gives you an indication here how far they can go without developing any pads and sustaining production at current levels. Where the ultimate recovery projected for some of those pads are at 50 to 60%, 60 to 70%. So they're basically on some of the pads they're getting there, but it's still very kind of, some of the pads are very young, 14, 17%, 38%, other 50. So that will take many, many years to basically develop these resorts. And sometimes recovery to date from the recovery factor, you could be producing like, let's say 58%, where you like 60 to 70 here, but you could be also producing 64%, where the estimated is 50 to 60%, right? Where the estimated ultimate recovery from SBIP will be 60 to 70%. So you can kind of gauge a little bit more about like how young those pads are. And so here is SAGDable bitumen in place, and this is original bitumen in place. And so you can kind of say, okay, SAGDable bitumen in place is 60 to 70, so I'm at 64, so that's a late life pad, so it's probably seeing in situ co-injection. So you can kind of look at things that way as well. And again, this was kind of how we started this presentation with this graph. And I think right now they're producing something like 85,000 barrels per day because of the turnaround they had in 2023. And last year they also had a turnaround. And so, but you can see the production is like almost at all-time high on this pad without the turnarounds. And in overall, the asset looks extremely healthy. So at this point, I want to cover maybe like show you their presentation and earnings and kind of go from there. But before I do that, let's kind of think about what some people say here from BNN Bloomberg and CNBC, and what people say about this company recently, just kind of to cover some thoughts about what others are saying, just so it doesn't become like maybe not an echo chamber, but like a situation where there's maybe a bias. So Keith Richards, he was on BNN, and he was asked about this company. He does technical analysis. He doesn't do fundamental, just like what you see in here. And so what he's been saying on Market Call is that the energy stocks have had similar patterns. You could step into energy where there, since there should be eventual breakout, and you saw in the chart how it kind of keep testing those breakout ceiling patterns. In MEG, he's been saying that it's going sideways, and it falls within the typical energy pattern. Some other people that notable that visited BNN, I think end of May. Eric was, I think my understanding, Eric is one of the bigger shareholders of the company. He mentioned that they should meet the final debt target by year end, and we're going to be looking if that's kind of something that's doable for them. And after that, he said they committed 100% of free cash flow to shareholders and buying back stock, and he remains incredibly bullish on it, more than a double from here. And I think it's what's important to remember is that so right now they're close to $7 billion in market cap, and about $1 billion or 1.2 billion Canadian, and just under 1 billion US in debt. So the company trades at like close to 80,000 per flowing barrel, which is very interesting. And from a historic basis, this is a name that trades right now at somewhat of a premium, one could argue. So let's look at their presentation and see if we can confirm some of those kind of statements associated maybe with their goals and what they want to do when it comes to their debt reduction and kind of a strategy when it comes to what they're going to do with the free cash flow. And then we're going to be looking at the actual free cash flow, understand if they're in line with meeting the debt target goals as mentioned by others. So essentially, yeah, so here what you see, enterprise value 8 billion. Yeah, so this presentation is from May 2023. And what they're saying here is that enterprise value about $8 billion, so 1.4 billion. I think right now is 1.3 and 6.9 billion market cap, but back then in May it was 6.6. And everything I showed, like from the AER presentation, is in that mapped area. Is located kind of like south to Fort McMurray in the Christina Lake region. So we looked into their pads and their patterns and how they basically produce their oil. And you can see their SOR is 2.2, and it's exactly what we confirmed. So essentially $8 billion company right now, enterprise value. And you can see the bitumen production profile, end of 2023, over 100,000 barrels per day, which makes sense because they're producing 85,000 based on turnaround, but they're going to drain that oil to the producer without producing, and they're going to flush it as we speak probably. So there will be a slightly more elevated rates coming into basically Q3, Q4, in my view. But let's see what they said here when it comes to their debt and how they're going to be allocating this. So, or how they're going to allocating free cash flow, and we're going to see what it is. So if you think about their program here, stage 1, 2, 3, 4, they've been very good at committing the debt targets and kind of executing as they said they would. So when the net debt was 1.7 billion to 1.2, the debt reduction was 75% and 25% when it comes to the free cash flow allocation. And net debt, sorry, and net debt here was 1.2 billion to 600 million. So right now, essentially, we're in stage 3, where they're going to get to 600 million US in debt. And at this point right now, they allocate 50% to debt reduction and 50% to share buyback. So there's no plan up until they get to 600 million US debt. There's no plan to pay dividends. So sometimes I would hear people would say, well, how come MEG is not paying dividends? Well, they never told you they're going to be paying dividends because they're paying down debt and they're buying back shares. But when they get to 600 million in US debt, and right now I think it's about just under a billion, 900 million something, they said they consider base dividend, further debt reduction, share buybacks, and production growth, right? So maybe allocate more capital towards growing production a little bit. Even though, to be honest, based on what we've seen so far, they probably don't have to do it. And so what you see here is essentially a very calculated strategy. Now, this quarter, the free cash flow was about $130 million in my, from what I remember. We're going to open their earnings to look at the quarter. So if if they allocate 50-50, yeah, if you have elevated oil prices, maybe you could realize that 600 million US debt by year end. You could, but if oil prices stay, let's say, at under 80, then it could be difficult to meet the debt target by year end. So we're gonna have to stay kind of kind of see what they're gonna share with us. Now, if you want to learn more about this presentation, you could refer to my previous video for Q1 that I've done talking about MEG and in more details. But you can see here, like even when they talk about the 1.94 billion barrels of 2P reserves greater than 50 reserve live index, in my previous presentation that you just saw from AER, you can really see how where those barrels are located. So there's a lot of confidence that they're actually telling the truth here, because I think from the development area they produce something like 12 or 13%, and 7% from the overall recovery area. So they have many years ahead recovering oil at current rates without seeing basically a decline as they stage their NCG co-injection and bring in pads online. So that's very exciting. Let's see here if there is anything else that's kind of noticeable. They didn't update their presentation, but this, you can see this is from Q1, 161 million free cash flow, and you can see how debt buybacks, share buybacks, how the capital being allocated from kind of the adjusted funds flow, I guess. So yeah, this is mainly Q1 related, and so we're gonna look at their current earnings, basically from what they shared last week, which is going to be like fresh knowledge share here for the listeners. So let's see what they actually reported and kind of go from there. All right, so this is here will be their earnings. So now you should see on the screen basically what they reported in second quarter of 2023, June 30th. So period ended June 30th, and today, as I'm doing this live, we're in July 30th, right? So something just to be mindful of. So as mentioned here, they talk about bitumen production of 85,974 barrels per day, SOR 2.5, reflecting the impact of the major plant turnaround in the quarter. So they achieved that, so that's good. And funds flow, adjusted funds flow, 278 million, which is 0.96 per share. And the free cash flow is 129 million after 149 million of capital expenditures. And so the previous quarter, Q1, they had 160 million in free cash flow. And obviously they produced a little bit less because of the turnaround. But as we've seen in my previous chart there from the AER, those turnarounds is routine maintenance that must happen every couple of years. And it's a good thing that they completed that, and now they're basically proceeding into potentially a higher oil environment, producing a little bit more oil than before. Because the oil kind of settles at the producer, and they can flush it and produce it from the bottom now as they ramp up their pump speeds. So they repaid 40 million US in debt, and current debt declined to 994 million. And I think, like from what I shared, there was this kind of assumption that maybe they could achieve their debt target by year end, so Q3, Q4. But if they repaid only $40 million in Q2, you essentially need 10 quarters just like this to meet the maybe 400 million and then meet that 594 million dollars in debt and reduce it by 400 million, let's say US, to meet your stage 4 target where the free cash flow is allocated 100% level. So I think that assumption could be a little bit challenging here because you need a higher oil environment to generate the free cash flow to pay their debt to meet the debt goal target of 600 million US, so you can start distributing 100% of the free cash flow back to investors. So this is something that I think is important to be mindful of. And nevertheless, the company now trades at 8 billion EV with 994 million in US in debt, and it's 1.3 billion Canadian. So yeah, something important to kind of to be mindful of. And they returned 66 million to shareholders through buybacks and cancellation of 3.1 million shares at a weighted average price of 21.51, which is kind of nice because now the price is higher. I think it's closer to $25. So it's always nice when you buy shares for much cheaper from where you were buying them back. Okay, so now I want to actually go to the tables and take a look at kind of the numbers themselves so we can better understand what where we go from here. So you can see the capital expenditure program, so 450 million. That's the summer of 2023 guidance. The bitumen production annual average will be 100 to 105. Because it was 85, I expect Q3 be in production much higher. I think it could be as high maybe as 110,000 barrels a day. This could be a very realistic scenario. I think we've seen last year a quarter where it was 110,000 barrels per day. And so if you average in 100 to 105 and you produce 85 in Q2 and you have all of that bitumen kind of drained towards the production wells and you'll be flushing that production, Q3 should see much higher oil production here, in my view. Non-energy operating costs are very small, so about $5 per barrel, and G&A expenses just under $2, which is great. So that looking good. I really like this table because it gives you kind of sensitivities of the adjusted funds flow, which is highly correlated with crude oil benchmark prices and light heavy oil differentials. So here they say that the table provides annual sensitivity estimates to most significant market variables. And I think it's really important to consider that table and understand it. So every time you have WCS differential, US dollar per barrel, and when you have a movement in plus minus $1 per barrel, you basically see plus minus $45 million in adjusted fund flow sensitivity for MEG, which is huge, right? So when we had WCS differential is like $30, MEG really struggled with those numbers, but I think right now it's close to 15, so it really benefits them. I think like up until recently, I think the differential was $11, so that really benefits MEG. WTI US price per dollar, and so if you have $1 movement, that yields 27 million. So now you can start thinking, okay, adjusted fund flow sensitivity, if I have, let's say, a $10 move here in WTI, which is what we've been seeing, going from 70 to $80 WTI, then you could expect 270 million in adjusted funds flow on the positive side, which is significant because when you report free cash flow at 129 million dollars and in Q1 160, and here you have a move that gives you 270 on the adjusted funds flow, assuming you spend the same capital expenditures, then on the free cash flow, basically you're purely gaining that benefit. So that's a massive kind of component here. And WCS also benefited from earlier this year, late last year, differentials where those two numbers really impact your funds flow. And so from that perspective, if you very bullish, if you think like $100 oil and $15 differential, let's say, you could be in an environment where maybe you are meeting the debt targets by the end of this year, which is great. Now, bitumen production impacts you in a way where if you produce plus minus 1,000 barrels per day, you get plus minus 17 million in Canadian in your adjusted funds flow, which is awesome. And condensate, which has been this big story in Q1, that impacts your adjusted funds flow by 14 million when you see a movement of $1 plus minus, so 14 million. And that was a big story in Q1 for MEG, Athabasca, Cenovus. But that since then the condensate differential really kind of narrowed. So the impact for Q2, Q3 should really benefit companies like MEG. And then you see some smaller numbers like AECO gas, which in the community we've been talking a lot, but reality is that you have like $0.50 here Canadian sensitivity to related to 2 million, which is not much. So at the end of the day, in non-energy OPEX, if you have 25 cents, that impacts by $6 million, and exchange rate has the even bigger impact than both of those combined. But the conclusion here is that WCS differentials and WTI prices and oil production are the key kind of sensitivity to the adjusted fund flow, which is really important to be mindful of. Okay, so let's go and kind of see the actual. I'm really excited about sharing this because this is where the actual information is, right? This is where we can see the actual numbers and what was generated. So I'm just scrolling down to this table here. And this table summarizes operational and financial information for MEG Energy. And the dollar amounts are stated in Canadian dollars unless otherwise specified. So everything here is in Canadian dollars. So you can see here in Q1 they produced 106,000 or close to 107,000 barrels per day. Because of the turnaround, they produced close to 86,000 barrels per day in Q2. But I expect this number for next quarter to be close to Q4 of 2022 because of the flash production phenomenon. So that's my personal view. Not investment advice by any means. You can see a little bit of that phenomena here, where in Q1 you produced 101 for 2022, then you had this turnaround, which is kind of retrospectively, it's kind of unfortunate because Q2 last year was really high oil prices, right? But those turnarounds, you can't really plan, like you plan them ahead and you can't really like not have them. It's kind of like something you must do to maintain your facilities and have good integrity and safety associated with your operations. So I know people could get mad that, well, why did you have to do turnaround? But the reality is it was planned, ahead of time, and nobody could see the, Russia war in Ukraine and oil prices going that high, right? So, it is what it is. But you can see post 67,000 barrels per day, you saw 102,000 and 110,000. And so it's very much expected here that those prices, especially if they're guiding 100 to 105 the rest of the year, then if you take that average, that's about 90. So you need 110 to meet their guidance. And I totally expect Q3, Q4 having numbers about 110,000 barrels per day, maybe slightly less. So here you can see basically bitumen realization after net transportation and storage expense. So dollars per barrel, right? So you can see $57 in Q2, 43 in Q1. You can see very elevated prices like in Q2, like we talked about, and and this is like really realized pricing. So Q2, oh, I wish they could produce the 110,000 barrels per day, and I think they know it too. They probably know it. They're like, oh my God, I wish we got that price. But right now for Q1 you had 43. In Q2 you had much more elevated prices, and mainly because we've seen WCS differentials really narrow there, and the condensate price is going down a little bit on a relative basis. So that really benefited the company. So operating expenses in Q2 actually went down a little bit. You can see a really nice trend when it comes to operating expenses. So that's really good. But maybe it has something to do also with the turnaround. Okay, so non-energy operating cost dollars per barrel, 566, 477 prior to that, and cash operating netback. So that's an important number here. In Q2 2022, it was almost $82. Q1 it was 34, and now it's like 42. So that was essentially quarterly close to Q4 2022, which was a good quarter as well. And you can see the G&A expenses are very low, just under $2 for Q2 2023. And you can see kind of how they combine the 6 months, basically they combine those two numbers and report it in this table here. So funds flow from operating activities, 278 for Q2, 348 for Q1. And free cash flow 129 for Q2 and 161 for essentially Q1. And on revenues is about 1.3 billion and close to 1.5 billion. So then if you look at what's the multiple, let's say the trade at on average, if you take the 6 months, which is, let's say, so for 6 months 2022, so 1.38, so you take 1 billion and divide it by 1.4, let's say, so they traded close to 6 times revenue in this company, if anybody cares about that metric. So capital expenditure 149 per quarter, maybe a little bit more for the turnaround expenses, and 113 in previous quarter. And long-term debt in Canadian dollars is 1.38, right? Net debt 1.3, because I assume there's some cash maybe, or cash equivalents in the books, and 994 US, because they specify the US here. So yeah, and you can see how from last year you basically saw a reduction of 390 million or so from basically June 2022 to that level. And so that suggests that to cut another 400 million, this could take a year, right, from now till you get to 500 million something if you operate at stage 3 as communicated to get the debt reduction level. So this is something to be mindful of, right? So really important here. That they basically told us that they're at stage 3, 50% buybacks, so buying back shares, which they've been successful in doing. But are they going to be net that target for Q stage 4 to return 100% of the free cash flow to investors? We need $100 oil here to see that. But in overall, you can see on the production side, essentially no decline, and they produce essentially on that production curve. So I think it could be useful if I go back to it and show you again kind of the production and turnarounds that now that we're a little bit more kind of educated on this topic. So yeah, so right here you can see every time they have a turnaround, production declines, and you have small flush here, small flush, turnaround, increasing basically steam injection rates and water production rates is correlative with WSR water to steam ratio of 1. Oil production increases. Again, every time it declines, it increases as well. And so right now we had a turnaround, smaller turnaround, just like here. and you expect higher production Q3, Q4, which if we go to a higher price environment should really benefit MEG. So that's exciting. By the way, I promised to showcase what this presentation is. So if you Google it, it's Christina Lake Regional Project 2021 Directive 54 Performance Report. So really important to kind of to check it out to really understand the company. And I think I shared this before, but the story here is fairly simple. It's like one asset, one recovery scheme, very predictable production, right? You can see in table 8, sorry, on page 8 here. All right. Second. And you can really see in this table where they specify basically the resource, where they're at when it comes to the recovery on each and every pad, how much oil saturation they have, how much recovery to date. And so there's lots of room left to recover those pads, and you can see their expansion program for essentially like how they're gonna grow the asset or sustain production at the current levels, which is great, right? I'm really glad they're able to show it to us. So future plant development areas, you can really see where they want to be. Like here, I think this is on the south side. I think those wells are Christina Lake, so you can see how close Cenovus is to MEG, and the lake here is on the west side to of Christina Lake MEG asset. So this is like very delineated region where there's really good understanding of where they're gonna basically drill the next wells. And so let's kind of have a memory capture here. So those 3 pads here, and they want to put another one pad here and see why they're gonna do it. And then here at the bottom on the south side of that pad. So let's see on the isopox why they want to go there. Take a little bit of a deeper look. So let's take a look here. Okay. Yeah. All right. So yeah, minimal bottom water there and here. So that's good. And let's look at the actual project area and the net pays isopox. So they want to land a little bit lower here, which makes sense, and here, which is kind of high oil saturation, high pay region, and very predictable because they've been kind of landing those patterns here. It must be very successful, and you can see they've done it before on AQAPAN on the west side, kind of putting perpendicular pads or patterns to the previous ones. So yeah, that makes a lot of sense, which creates an environment of very predictable oil rates. You can see here, here, they're going to develop that region. So let's see here. Yeah, makes sense. So that pattern DE, let's take a deeper dive in DE, see how successful it's been, because they're going to put some pads next to it, adjacent to it. So maybe they're trying to kind of recreate some of the soil productions. So let's see DE. Yeah, DE. Yeah, very early stage. So you have nice pay thickness, so 20 meters, high porosity, 33 percent, average oil saturation 68.9, high permeability, decent original bitumen in place, and a lot of it is subduable bitumen in place. And like one challenge it could be that you can have a lot of bitumen, but maybe you have some heterogeneity where it's difficult for steam to access and drain the oil. So they basically tell you there's 3.6 million cubes of oil there, which is, so you multiply 3 times 6.29. So that will be close to 19 million barrels recoverable, and they produce only 2% of that. So they're probably seeing good results. That's why they want to land more wells kind of in that region. All right. So what we've done so far, just kind of take a quick review of what's been taking place. So we looked at the comparisons for MEG relatively to other companies. We did see amazing performance. I think one gentleman on BNN actually said that um, uh, so I think it was Dennis De Silva. He said that he doesn't own MEG or Athabasca. He sticks with light oil, uh, and that's his like top picks, right? He would pick MEG because it's larger cap, better liquidity, and institutional ownership. If you compare this to Athabasca, I respectfully kind of disagree with that statement, but that's my personal view. And he said that Athabasca is more focused on debt reduction. I guess both of them are focused on debt reduction because they want to achieve their debt reduction goals. But Athabasca is not really. It has a lot of cash on the book, so it could pay out a lot of its debt because it has all this cash. So, um, and MEG, that he says it does buybacks, but we know it does 50% of the buybacks as per stage 3 strategy. And he said it prefers dividends for income and rocky stock performance. But MEG been like doing incredible, so it's not bad performance at all. So what you've seen so far today, we covered basically the name in detail. We talked about MEG, $8 billion or so enterprise value, producing 100,000 barrels per day or so. So the name is kind of getting there. It's not necessarily cheap like it used to be. It's just something to be mindful of. Yeah, we looked in their earnings. So the market like the earnings. The name did not get hurt. It was up, I think, 3%, but also oil prices were elevated during when they reported. So they moved higher. So it's very difficult to tell like if it was incrementally higher because of the earnings or the earnings were kind of met expectations and the stock moved because the oil prices just moved. And we also looked at their presentation that they're stage 3, so 50-50 capital allocation. So free cash flow is going towards debt reduction 50% and buying back shares 50%, but no dividends. And again, yeah, please do your own due diligence. And if you consider investing in this name, talk to a financial advisor. This was aggregation of a lot of data to be more specific about MEG and their earnings and what they do. And hopefully it provided a lot of value to the community on Twitter and YouTube to better understand why many people like this name and why people kind of appreciate MEG and invest in it. So, cheers, everyone. All the best, and thank you for joining me for yet another session on oil and gas earnings. And I will be doing more of those sessions for Cenovus and Athabasca and Crescent Point and other names. I just prefer this format a little bit more than Friday Razor Spaces because I believe it adds more value to the community. So thank you all so much, and please watch this on YouTube because sometimes I could be very slow in the way I speak. So all videos I watch on YouTube is double the speed. So you could really benefit from adjusting the speed and listening to me a little bit faster. So it's not maybe as dry and boring. I hope it wasn't, and I hope I was able to add a lot of value to you guys. So thank you so much. Have a wonderful